Good morning and welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, for this Tuesday edition, the pre-hump day edition of 3 Minutes. Markets continue to struggle at all-time highs, unable to quite get there. We tried it again yesterday, failed at the end of the day. We're going to try it again today. Dow futures are up right now about 50 points or so. So we're going to try to make another attempt here at all-time highs. Again, this isn't a big deal here. There's lots of support between the 50 and the 200-day moving average sitting really kind of just below this. But there is the potential here for a 5% correction or so in the market. Certainly not surprising at this juncture after such a big run really from the March lows to have a bit of a correction here, a bit of a pullback. We did see a pullback in June and July. Again, seeing the same type of pullback here over the next month or so. Certainly not outside the realm of possibility. The money flow buy signal is very extended here, and money flows have begun to tailor off here a bit. The last time that we saw money flows at such a high level and begin to taper off, we had a little bit more of a correction in the market as well. So again, there's a couple of things here that suggest we may see a pickup in volatility. We talked about last Friday adding bonds to our portfolio for this very reason, because bonds, as opposed to the stock market, which is very overbought, bonds are now very oversold. So we added some more bond positions to our portfolio, picking up some additional yield, but also getting a potential here for a bit of a hedge against a correction in markets. We also began yesterday removing some of our exposure to equities. We're going to look to rebalance a bit of our portfolio to a little bit more defensive structure in our portfolio. So again, trimming off some of our more aggressive positions that have run up sharply in price, like UPS, Microsoft, and others, and swapping those for other positions that are more value-based. We're looking for a little bit of a value shift within the portfolio, because such a value shift will provide potentially a bit of a hedge against a market decline when it occurs. Plus, we can pick up a little bit better yield in those positions as well. So again, the point here is just to hedge a little bit against potential volatility pickup as we head into the election. Certainly would not be a surprise. Again, lots of unknowns here over the next couple of months, and particularly when it comes down to more stimulus for the market. What's been driving stocks really, as well as bonds, from the lows has really been all this additional stimulus in the market. Right now, there's not a lot of talk about getting another $1,200 check to households or benefits back added to the unemployment benefit rolls. Not a lot of communication about getting another bill passed. We'll probably get one. The timing is going to be the important part, and can the market survive long enough without getting more stimulus in the markets? My suspicion is that it's going to take a bit of a reversion in stock prices to get Congress to move quickly and the Fed to move quickly into getting more liquidity into the markets. The Fed really needs a bit of a correction here to justify increasing QE and putting more liquidity back into the markets. With markets sitting at all-time highs or even at potentially new highs, really removes the ability for them to act in this environment. So again, pay attention to risk here. I think it's a little bit elevated. The S&P, again, trying to make all-time highs today. We'll see if we can do that. If we don't make new highs fairly soon, the risk of a correction continues to mount. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you tomorrow.